So I was watching a webinar on 401ks, the history of 401ks. A, do you know when the first 401k plan was offered?
1971.
A little early, 1980. Seems I would have thought 70s too. 80 seems late, but it was 1980. And the first 401k plan, there were only two investment options: guaranteed income and equity mutual fund. And you could only pick, this is great, in increments of 25%, and you could only make up to four changes a year each quarter. And why was that so important? Because in September 87, after the giant crash, those participants that had left before the crash, whether it's because they switched firms or retired, whatever the case may be, the ones that stayed in had to make up for the losses for those that had already left.
I no, I know it's easy to take for granted. Do you know, yeah, this is probably not there. I wonder how many investment options were actually under the hood of the two funds. Like, was it the Wilshire sitting under that fund? I bet you it was like 30 things, maybe. It was your favorite Dow, brother. It was your favorite Dow.
I'm better than nothing, right? I mean, at least it was an option, but you had hardly any flexibility.
Yeah, I agree. But also back then, you know what everybody was relying on?
The paper.
Sure, but also defined benefit plans, bro. Those don't exist anymore.
Welcome to Talk Your Chart, where we cut through the noise and look beyond the headlines using data, history, and perspective. I'm Brett Horowitz with Marcos Segrera. The first chart we have today, Marcos, is Consumer Price Index for goods and services. It's maybe a couple months old, but I think it really tells the story as to why is inflation not coming down. I think we were all surprised that with all the tariffs, with the rising of gas, inflation is still relatively high, but it's not due to goods. It's mainly due to services. So in 2010s, the average annual rate for service inflation was 2.1%. It's now around 3.3%. And that's a big reason why it stayed above the 2% Fed target. The reason that I'm hearing that that's the case, economists are saying that, right, people have jobs, unemployment rate is low, stock market's going up, so people feel really wealthy. And as a result, wage inflation is high, and that leads to services then being jacked up in price.
Yeah, 3.3%. I'm looking at now. Today's May 5th. Energy's annualizing at 12.5%. I wonder why. I wonder why. We did Project Freedom yesterday, so God knows how that's all going to come to an end.
The immigration thing is not helping either, because the less immigrants you have, the less people competing for jobs, the more you got to raise wages to get remaining workers to work for you. Now, the middle and lower class are going to have that hurt them more than others. So there's a limit to how much you can raise prices on services before people push back.
Yeah, I hear you. There was a chart that I don't think we did this last episode, but it basically just shows what the share of consumer spending that is represented by energy, right? So like if you look at the 80s, it's like almost 10%, right?
Right. Three
And
and a
then
half.
now it's 3.8%.
Right.
I was in Turks and Caicos as we were talking about before we started recording last week. The price per gallon there, my friend, $6.50. That's what happens when you have to import everything, huh? Which just kind of leads to the point of now we're a net producer, right? A net exporter of oil. Hashtag fracking. So
Yeah, but
just
how much have we heard from earnings reports of companies saying like all the problems that we're seeing is due to the tariffs from last year, to the oil this year? Obviously, companies like Spirit, yeah, and airlines, but for the most part, like it's that's not the issue here. It's services.
yeah, I guess it's interesting. Does it talk about what services specifically are impacting that?
No, I don't know what it is. It's not how it says services excluding housing.
Is it? Oh, did that include? Oh man, especially being in Miami, insurance costs. Have you seen that? 2 years ago, when health insurance prices were deflationary, and everyone in the world was like, "That's a lie. That's just a blatant lie. That's just not happening."
It's housing, it's cars, it's everything.
I know. So I wonder if insurance is part of that. Yeah, look. So you bring up CPI. This just makes me want to look at the 10 year. The 10 year is hovering right now like 4.4. It's obviously spiked since April, right? It
Yep.
feels, it's kind of funny, right? We're repeating last year, except the market is not down 20%. The market's hitting all-time highs. Whoop-de-doo. But I think that's obviously the AI innovation story and less about what's happening with tariffs. But I'm going to tell you, man, a 4, 5, 10 year just makes me nervous, much more than a stock market down 20%. Um, a 30-year mortgage over 6.5% also kills me.
Yeah, well, look, it's high. Again, we've talked about this over and over again. It's not high relative to history, but it is high, and we were approaching five, I think, or the high fives at one point. So now, yeah, we're 0.5% higher than that. It's not looking like it's going to come down anytime soon.
No, it's terrible. It's absolutely terrible. I'm building a home supposedly, and I need it to change. So, in any event, we have our new Fed chair coming in also. Best of luck to that guy, Mr. Warsh. Have you seen his balance sheet that he disclosed? He's done okay for himself, north of $100 million. Good for him.
Right.
Yeah, good for him. He's just like you, brother. He's gonna pop in if he cuts rates. What do you think the 10-year Treasury is gonna do if he cuts rates?
But look, he can't cut it by himself. He's got all these Fed governors. You got to get like what, 7 people to vote. Like it's not just he can cut rates himself unilaterally.
I hear. What do you think happens to the 10-year if he cuts rates?
It goes up.
Of course, it's gonna go up, like it has the last two times they cut rates. What else do you have for me?
Okay, so let's talk about the man, the myth, the legend, Doctor. I don't know if he's a doctor. Henrik Bessenbinder. I have his beautiful paper right here because he updated this a few years ago, a few months ago. Sorry, in March. I'm going to send it around, but I wanted to read it first to see everything that he has to say. So why do we love this guy? He did a study back in 2016 talking about how likely you are to find a stock that outperforms the treasury bills, which are, the lowest, most least risk asset out there pretty much, other than sort of putting money in the bank. And he found that the chance of picking the best performing stock out of a hat is 0.02%. But he updated his results in 2025, and he looked at about 30,000 stocks that have been in existence for as long as they've been in existence. Some going back 100 years, like Altria, some not that long. He noted that in his new result, 17,000 of the 30,000 firms reduced shareholder wealth. The next
That means
11,000
negative cumulative returns.
above the treasury. Yeah, so they did not outperform the 1 month treasury. The next 11,000 firms generated some wealth, and only 1,082 firms actually accounted for all the shareholder wealth. Now that was the numbers from last study. He now added to that and said, of the 1,082 firms, 46 accounted for half of the net wealth created. You brought up Altria before, being the best performing stock in its history. It is over the last 100 years. You would have turned $1 invested in 1926 into, drumroll please, 4.4 million if you had held it for 100 years. And you would say, my God, that is amazing. However, if you do the math and you average it out per year, the S&P is around 10% per year. Altria comes in at 16%. So impressive, but not earth-shattering like 1,000% per year.
But brother, that's the failure of the human brain to appreciate what 16% compounded for 100 years looks like.
Yeah.
That's a bonanza number. That's better than medallion.
Well, you've got to have probably a lot of conviction to hold it for 100 years and to not bail out.
Yeah, exactly.
Because there's been some trying times with the cigarette companies. The other fact that was interesting, the median buy and hold return of the nearly 30,000 stocks in the study, negative 6.9%. So the average stock that got bought and was held is actually down.
Man.
So Dr. Bessenbinder is telling us what we've told all of our listeners and viewers. Stop trying to pick individual stocks, people.
Yeah, stop trying to do it with a lot of money, but doing it with a little bit of money is fun. And you know what? I'm going to take the other side because I love Hendrik. But you know what Jim Simons would tell the Hendrik Bessenbinder? Go fly a kite, buddy. Because since 1988, his Renaissance Technologies Medallion Fund has annualized approximately 40% averaged annualized return.
So why is it not in the portfolio?
You think you want your money? He doesn't want my money. He doesn't want anyone's money. That guy figured it out. It's so funny. There's a good book about Jim Simons, who, by the way, he's probably smoked more cigarettes than there are people on the planet. It's just a funny little quirk. He was in an interview, I forgot on what, and they asked him about one of his portfolio holdings. He brought up a stock that wasn't even publicly traded anymore. He forgot what it was. They were pure quants, so they just ran these mathematical algorithms and formulas and just ended up with a stock. They never cared what it was, right? They never did a fundamental analysis. There was no Warren Buffett drinking Coke with this guy. It was all, I hire people who know how to read the stars. I make them do a lot of math, and then we pick stocks based off some algorithm. And it worked out pretty nice for them.
Or that was a lot of luck, which I'll get to in a second.
Oh, baby. Luck since I was born. All
Be,
right,
be,
good. Let's go to
before
luck.
that, though, there was also a huge article this morning. I don't know if you saw it in the Journal about Polymarket and Kalshi,
Yeah, what about it?
and and about I think three-quarters of people that invest in that or invest, pick, predict, lose money. Most of the people do these mention bets, where they hope somebody says a word or says a phrase, and
Yeah.
they said that the odds of that happening are much lower than what it's being getting credit for, and only about a few percent of people who are investing lots of money are making thousands of bets an hour. These are professionals. These have technology behind them. They're making all the money. All the do-it-yourselfers are coming up empty. So it reminds me of this. It's a sort of the same thing.
Actually, I'm going to forward you something. I sent something yesterday. I sent something yesterday out to my little email list. And what I wrote in it is, in a world of moonshots and viral trends, tons of younger investors feel a desperate need to accelerate their wealth building through high risk speculative assets. However, the real tragedy is that they don't need to take these risks to succeed. And I say that not from on high. I say it as a father of a 19-year-old who doesn't really do this, but is clearly exposed to this, and this culture is there's kind of a, whatever shape you want to use, X-shaped hole in these kids' hearts, and they're filling it with these kind of just desperate attempts at getting the serotonin and dopamine hits. But I digress.
Yeah, well, I think Kalshi was saying they used to have on their website like an ad that said, "Are you out of a job? Here's a way to make money."
Oh man, that's
They
aggressive.
took that down.
That's rough. That's rough. All right, what else do
Uh,
we have?
so talking about luck and talking about skill, because most of this is pure luck. There's a woman who is started figuring out how much of a fund's performance is due to luck and due to skill. So this is a woman, I forget her name and what company she works for, but so coming soon to Morningstar's website is going to be a new score where they analyze luck versus skill.
Oh,
And she shared these four life cycle profiles that someone could have, where we all want to be the linear accumulator, right? You pick a good stock, it goes up and up and up to the right, maybe has some dips along the way, but ends up being much higher than it started out. And then what you find out is that the most common, and I love the names, the hopeless romantic,
yeah.
starts off well and then goes poorly. I guess that could be a lot of relationships in Hollywood. You've got the coaster, you do really well at the beginning and just sort of doesn't do anything for a long period of time. But the most common experience of an investor is the round tripper. It starts off a little bit well, you hold it, you've lost all your profit, and then you keep holding it, and years later, you've now given up all the gains and now are down. And unfortunately, that's the experience of most investors. So coming soon to Morningstar.com is going to be this new number. I don't know how it gets calculated. I don't know how they figure out what's luck and what's skill.
I'm very interested. I haven't heard of this, to be frank. Again, no heat here. I'm not trying to poo-poo. Kathy Wood over at ARC. Yeah, I guess since inception she's probably fine, but off the peak, I doubt she's come back. I don't have the chart in front of me, but that just comes to mind when you talk about the round tripper.
Well, yeah, she had a heyday there for a little while where she was the guru of everything and then suddenly made a lot of bad calls.
Well, yeah. Again, she didn't own Nvidia, and I'm sure she's still seeing somebody about that.
Didn't she also say that like half the bonds in the universe were going to default, like some crazy announcement?
No, I think that was either Bill Gross or Gunlack, a failed soothsayer. Okay, so I thought these alpha life cycles were kind of generational profiles. I was ready to go like real brainy. I like it. All right, good. So, Brett Horowitz, have you ever been to a radiologist?
Thankfully, not.
You've never had a freaking X-ray, dude?
X-ray? Might have had an X-ray.
Of course you've had an X-ray. You're human, dude. How old are you again? Ooh, sorry.
Barely anything ever goes wrong here. I'm perfect.
And my favorite thing about you, other than your good looks, is your humility. I've always said that about you.
Humble and perfect.
I know. So humble and perfect. So let's look at this chart from our good friend Torsten Slock over at Apollo. The Radiologist Paradox. I've spoken about this a lot in the last 12 months because, as you know, I get a lot of college kids that reach out to me. Obviously, I head up and am in touch with the gatekeeper for our paraplanner role. So I've had the genuine opportunity of talking to a lot of these kids who are nervous about their job prospects coming out of college, which is understandable. Although historically the unemployment rate for folks that are graduating and are 22 to 25 has always been in the double digits, and it's kind of sitting there still right now. Is that it's hard to get jobs. Now AI is making this whole thing go crazy, and today is May 5th. I also want to make a quick note because something came out today, and I want to see, there was an economist out of, where was it? University of Chicago. I'm just trying to get his name. Alex Emis. He wrote, I'm not sure how long ago, just about the absolute Armageddon that was going to happen in the job market. And he published over the past few days on the paper that says, you know what, I've changed my mind. I don't think that's going to happen. And I think that's important. And I want this chart to kind of linger on it. And I want to focus on the dotted line that comes down and it says Hinton stopped training radiologists. And I just want to talk about what that is and what that represents. And this was back in 2016. So the phrase Hinton's stop training radiologists refers to a famous, and now controversial of course, prediction made by Geoffrey Hinton, often called the godfather of AI, in 2016. And I am going to give you context, so pardon what sounds like a soapbox here. So in 2016, deep learning was achieving massive breakthroughs in image recognition. During a conference in Toronto, Hinton argued that AI's ability to read medical scans would soon surpass human capability. He stated, famously of course, I think that if you work as a radiologist, you're like Wile E. Coyote in the cartoon. You're already over the edge of the cliff, but you haven't yet looked down. There's no ground underneath. It's quite obvious that within 5 years, deep learning is going to do better than radiologists. We should stop training radiologists now.
Ooh, probably wants to take that one back.
Yeah, it's so good. All these kind of just deterministic statements are always rough, right? That's why there are no guarantees, clients and advisors. So the chart here is just obviously calling out this paradox of, okay, yes, machine learning has made it better at reading AI, but humans still want the relational capacity of another human to interpret results for them and give them information. So instead of disappearing, the number of radiologists has climbed steadily from roughly 31,000 in 2015 to over 37,000 right today. The average income growth hasn't plummeted. It's gone from 350 to 575. I'm not sure whether that is inflation adjusted, but it seems okay to me. And then while AI is obviously used in radiology today, it mostly acts as a co-pilot.
Well,
So
look, he's either wrong or he's just early,
yeah,
right? Because oftentimes he could be right and just not be proven right yet.
yeah, I think what ends up happening is you get a economic sector comparison of commoditized automated sectors and then relational human-led sectors, which is what this guy Alex Emis is kind of juxtaposing. And he basically qualifies it as if you're a commodity sector, which can be automated, the product is usually standardized and reproducible, but there's a relational component that is unique and provenance rich. And I like that he uses the word provenance. And Brett, you lie in a world that can be provenance rich if done correctly. And might I say, you do a wonderful job of providing provenance to clients. That's why when people ask me, even internally, right, I always say maybe we'll start losing jobs to the AI, right? The optimist that looks like Brett and can think like Brett, but on steroids, in 30 years when people are born today and are just kind of AI native. But even then, if there's still too much of a human component to us, I don't know how you get away from people wanting to interact with people. And the last thing I will mention that Alex Emis brings up in his more recent paper is this idea of mimetic desire. And there's a book about mimetic desire written by, I forgot his name, but it's called Wanting. And it's this idea of we don't get into conflict as people because we want different things, but it's because we want the same things. And that desire that we all kind of have, and it's innate in us. It's why we copy people. It's why they say babies, when you stick out your tongue at a baby, they stick it back out to you, is that we want to do that with other humans. So unless, again, we start becoming these Inspector Gadget kind of biometric folks, I'm going to go that humans win, until we don't, of course.
Yeah, but it's already happening now, right? I mean, it depends on the value versus the cost. If you can get a human bread that costs, $500 an hour and the AI bread is $100 an hour, you might decide, hey, if I can get a very similar result for a lot less, I'm fine with not having that relationship. It's not for everybody, but I'm sure there are a lot of people that are already choosing to do that right now.
Well, no, and that's what I'd say is we've always said this. There's do-it-yourselfers and kind of delegators. I'll leave out that third category just for clarity's purposes. The do-it-yourselfers weren't going to hire us or the other kind of high-end accountant or super high-end attorney or concierge doctor anyway. But is the things, the prices are going to go down for those things, right? Ultimately, the prices will come down. People will become at that point relatively wealthy compared to what they were, and what are they going to spend the money on? They're going to spend the money on the meaning, which means trips, which means higher-end experiences, which means a Brett Horowitz who can provide more kind of quality and advice versus the optimist.
Well, that's what I talk a lot about clients when they're worried about, oh my gosh, gas is so expensive and now we're going to spend all our money on gas. And to your point, even if we're not spending more on gas than we did 40 years ago, that gas and those companies are part of this portfolio, just like everything's part of the portfolio. So where we spend our money on doesn't matter as long as we do spend money, right? The worst thing the economy can do is nobody spends any money. Why was COVID so bad for a few months? Because nobody spent any money. We need people to spend money on. So whether it's a radiologist or an AI radiologist or on Netflix or on vacations or whatever, as long as they spend money, that's the important thing.
Yeah, and I found that, and this just hits on what you mentioned. So he talks about income elasticity. As people get richer, because AI makes basic goods cheap, they don't just buy more of the same. They shift spending to things they value more at higher income levels, like education, bespoke art, and personal care. And this is now Baumol's Costastes, which is a kind of a relatively well-known economic principle. Sectors that are hard to automate, like therapy or high-end hospitality, become more expensive relative to automated goods. In an AI world, this disease becomes a labor market solution, absorbing the workforce and spending. And then he gives a Starbucks example. Starbucks tried to automate everything but failed because customers wanted hospitality, handwritten notes, and ceramic cups. They ended up hiring more baristas, not less, to drive satisfaction.
Hey, that's what a lot of us are doing here, right? Handwritten notes. They've gone the way of the dodo bird, and there's nothing better to get that in the mail. Be like, wow, this is not a bill. Someone who actually took time to write something.
Yeah, few things beat a crispy high five, Horowitz. And I can't tell you how many 19-year-olds I have told, learn how to shake a hand, and for the love of Pete, make eye contact. Make eye contact.
Marcos, it's only long in the absence of value.
Hey, where'd you get that from, brother? Sounds good. Have you seen this tattoo? Okay. So, Brett, again, we can kind of juxtapose last year and this year. It's kind of funny. There's an inflation scare both times, but we were down 20% last year, and now we're hitting all-time highs. What gives? How about earnings, brother? How about earnings? And this chart just shows you, again, this is forward earnings. This stuff can all change. As you can see from this chart, it kind of shows you it ebbs and flows. But, brother, we're what, doubling earnings per share since COVID?
Q1 earnings have been out last month, and they've been lights out. That tells more of the story than anything else. It'll continue, hopefully. So I think most of the companies have beaten their earnings so far. What people care about, not what's happening in Iran, which, look, if that continues on and on, what's going to happen? Companies are going to find, and countries find ways to get oil a different way, through a different strait, through pipelines, through using wind and this and that. I mean, it's hurting different countries differently, and we're going to adapt just like we always do.
Yeah, we will. We'll figure it out. Any last minute recommendations? What are you watching or reading?
I just finished Stranger Things, did not love it. Most importantly, Marcos, friends don't lie.
Wow, no, they don't. They don't. Well done. That's what you got from it. Good for you. Thank you, folks.